Welcome to ETU's free Mastermind CRT Bootcamp. In this chapter, we're talking about drawn liquidity, and there's gonna be two parts. First part is gonna be the short-term drawn liquidity. Second part is gonna be the long-term drawn liquidity, so we can get a understanding of it, right? The difference of it. If I make it both in one, you may get confused, or you might get confused, right? And this is a very important concept. It should be your first priority ever in the whole market. And without a drawn liquidity, you're basically pattern trading, right? But let's get straight into the lesson, to the chapter 13, right? Which is draw on liquidity. Okay. Draw on liquidity or directional bias is about understanding where the market is likely headed and identifying the most probable price targets is based on the time frame you're analyzing, right? So if you're analyzing a daily, 4-hour, weekly, right? This is the most important aspect of your analysis, and it should be your first priority in trading. Every other trade idea, trade setups, and trade narratives revolves around having a clear understanding of the market's drawn liquidity or directional bias. Without knowing the correct drawn liquidity, you're simply pattern trading, which is the worst approach. Now let's get to our next PDF. And as you guys know, this is not my PDF. I just went to Twitter and I just got somebody else's PDF, but I'm gonna explain it my way. As you guys, some of you guys asked for a PDF, and I'm doing this PDF thing for you guys, right? Without that, I wouldn't be doing a PDF. I'll just be teaching it. But some people may get confused, right? So some people does like to have PDF, some people don't, right? So I just got this freely on Twitter. So yeah. Importance of a drawn liquidity. The first and most crucial importance of a drawn liquidity is that it helps you understand what the market wants to do and where it's likely headed, rather than where you want it to go. If you wanted the market to go somewhere, you're involving emotions. This removes emotional and sentimental bias, keeping your approach focused, mechanical, and objective. With the correct drawn liquidity, you will always be correctly aligned with the market, significantly improving your trades, your analysis. Knowing the drawn liquidity or directional bias increase your odds of success and boost your win rate, since you're trading in the drawn direction of the market, or where the market is leaning towards, right? It acts like a filter, allowing you to focus on trades in one particular direction until the directional shift or until the drawn liquidity has been changed. It helps you avoid unnecessary. It helps, my bad for that. It helps you avoid unnecessary setups that might look appealing at first, but goes against the market natural flow, saving you from potential losses. Drawn liquidity enables you to scale into positions more confidently, knowing that you're trading with the market's order flow. It simplifies the decision-making process, right? By reducing numbers of conflict signals, not allowing you to act with clarity and conviction. That means if the drawn liquidity is bearish, you want to look for longs, right? So that would get confusion and decision-making easier, right? For the next PDF, there are two types of short-term drawn liquidity. There's two types of drawn liquidity. There's a short-term and there's a long-term. And we're talking about a short-term on this specific chapter 4. Next chapter is going to be covering the long-term drawn liquidity. Eventually, it's going to be covering everything that we learned about and implementing in the live data market. Short-term drawn liquidity. Short-term drawn liquidity helps you identify where the retracement profiles or shorter moves could end. It is used to determine where the market initially drawn to the immediate price action, basically. So your higher time frame price action would be the higher time frame, which is the weekly. Your immediate time frame price action would be the daily, and the lower time frame, which would you scale into the higher time frame or the immediate time frame to the position of the immediate or higher time frame direction, right? For example, when you're trading intraday, this is by the way, not mine, by the way. For example, when you're trading intraday, the short-term liquidity helps pinpoint where the market will likely make his first move like a liquidity purge or initial targets before making the major move, right? So basically a shorter move slash retracement profile. And this is what we're talking about in this specific chapter, short-term drawn liquidity, so you guys don't get it mistaken. If I talk both of them once, you might get confused and you guys might not have a smooth learning experience. This gives you clarity on where price might purge or reverse before continuing towards the higher, bigger draw on liquidity. Bullish, so short-term directional bias, right? We're talking about short-term drawn liquidity on this one, right? You can see the order flow is overall bullish, right? Our key level, basically our draw on liquidity, is here and here, right? As you guys know, market can't just go up. Market can't just go to the upside. It has to go through phases, which the phases are what? A short-term draw on liquidity. Another word for phases or short-term draw on liquidity, right? So why it is our short-term draw on liquidity? Because market can't just go up. There must be a region to this downside. Let's just say there's a daily IRL to ERL. So let's just say there's an IRL here as you're going to ERL, right? If you are looking towards the higher time frame drawn liquidity, which is the daily, which is the weekly, right? So let's just say weekly is upside. You're looking for a long inside of this, you would get wrecked. And let's see the next chapter. You would get wrecked because you did not wait for the short-term drawn liquidity. We did not wait for the short-term drawn liquidity to get met. So that caused you to take a lot of bad setups. Eventually, once the short-term drawn liquidity gets met, then it hits the long-term drawn liquidity, right? Next one, next example. Here's a perfect next example, right? Our long-term drawn liquidity is over here, but our short-term drawn liquidity has to go through phases. You can see our short-term drawn liquidity is over here. Market was over here, right? You can see markets go from a internal to external, right? From external back to internal. Once it's internal gets disrespected, market going to external. Once the external gets met, back to internal. Eventually back to external, hitting our drawn liquidity. You can see markets going through phases, right? So from here, the short will get met. Eventually, now we're going from a back to a long position, right? We're going from right here, right? That's fair value. If fair value gets disrespected, we're going here for our short liquidity, right? But you can see overall, our long-term goes over here in a higher time frame. You can see how daily is constantly going to that higher time frame, which is the weekly or monthly or 3-month, right? Let me show you guys another example. This was the same example as this, by the way. Same example. Market is going from market just tapped the internal, right? It could be either of these, right? But if you would have been smart, you would have looked at this, right? Market super out the low, super out the high, right? Daily range, this is a premium, this is a discount, right? So this you want to sell this IRL instead of this IRL, right? Facing less losses, as you can see, we have covered daily range on our chapter already, right? And you can see, boom, hit it, went up, right? Short-term directional bias. Our short-term drawn liquidity is a candle range high, basically CRT highs or short-term drawn liquidity. Our long-term drawn liquidity is over here. You can see we got a confirmation right over here, and so out of that, looking for a short all the way to down here, right? So basically, our long-term drawn liquidity is over there, right? Short-term drawn liquidity. Short-term drawn liquidity helps you identify where retracement profiles or shorter moves could end. Is used to determine where the market initially drawn to the immediate practitioner, and as well, we've already covered this, right? But to give you another thought process, right, to this, right? Now let's go to the market live data and teach you guys about this, right? Market live data, right? As you guys know, this is a short-term liquidity, not a long-term. So let's go to the weekly. Your high time frame drawn liquidity would be your high time frame / your long-term drawn liquidity would be the higher time frame, right? Your long-term drawn liquidity in a higher time frame is overall, let's just say in this case and this day would be a better example for us to give it here, right? On the long term, right, your drawn liquidity is overall bullish, right? To all the way over here, right? So the long term, your drawn liquidity is going from a external to internal, right? Right? Now that's your long term. Now you go to daily time frame. Let's see what's up with daily, right? Daily, we're going from a daily internal to external. You can see how daily is aligning with the weekly. This could definitely happen, right? So, like that. So daily, just got met, right? So daily, strong liquidity got met, right? Right over here. Here's a strong liquidity. Eventually, until this short-term liquidity until this fair value gap does not get good, until this fair value gap get disrespected, we're looking for shorts, right? Over here, we're looking for shorts. I had a day over here for a short. Boom, another shorting day. Eventually, one just get disrespected. We're going for the high that created the internal, right? So our long-term liquidity, our short-term liquidity was back to the downside, go from internal to external, but this fair value got disrespected. So we're going back to long-term. You can see our internal. You can see our short-term liquidity constantly changes, right? You can see our short-term drawn liquidity constantly changes, but our long-term drawn liquidity does not, right? Until it gets met. So now drawn liquidity is over here. So boom, we're going from external to internal data. This get tapped back, right? Possibly did, right? Boom. So now you can see our long-term drawn liquidity is over here. Our short-term drawn liquidity is right over here, right? External to internal, right? From here now, we're going back from internal back to external, right? Just waiting for the market. Our short-term liquidity is going from a candle. You can see right over here. Market soup out the low first, then eventually soup out the high, touching the fair value gap. Market, you guys know, market cannot just go from a internal to internal. It has to go from internal to external, right? So market disrespected this. Went above it. We're gonna go to the high that created it, right? So now you can see how the short-term drawn liquidity is constantly changing to the high type of drawn liquidity, right? But the high type of drawn liquidity is not. You got tapped. Now we go from external back to internal, right? This fair value gap right over here. Now the weekly objective got changed from a internal to external, right? So our long-term liquidity got changed to the downside, right? So now let's go to our short-term liquidity. Our short-term liquidity is to the downside as well. Boom, it got met. Right now, once it gets respected, we go to the low that created it, right? So now, boom, this low gets tapped right over here. Nope, not yet. This low gets tapped right over here, right? This is Friday as well. We're going from a external back to internal, right? Because this fair value could be reused, right? Because there's no fair value gap here, so this fair value could be reused as our internal, right? So from this internal, we're thinking about going back to external right over here. Market close below it back. So going back to external right over here. Back down to external, right? You can see how short drawn keys aligning with the high type of drawn liquidity, right? Over here, our long drawn keys here. Now, market show at the low from a daily and a short drawn liquidity. Our drawn liquidity is back to the upside, right? But overall drawn liquidity is down to the downside right over here, right? You can see go from external back to internal, right? So our drawn liquidity, the short drawn liquidity constantly changes, but the high term drawn liquidity is not. So the long term does not change, but the short term might make constantly change, right? To upside, downside. But eventually you'll go to the long term, right? So you'll be heading to the long term, right? Because you guys know, market just can't go down. It can't just go up, right? You have to go through phases. So short-term liquidity is basically phases, right? You can see market is currently soup it out, external, right? Internal, back to external, right? You can see short-term liquidity is constantly changing here, right? But yeah, this is our short-term drawn liquidity, chapter 13. Chapter 14 will cover long-term drawn liquidity, right? So where we're gonna go on a long-term basis. And if you guys are new, make sure you guys take notes. Make sure you guys look at the previous chapter, take action. Make sure you guys take notes because the previous chapter will use the new chapters, and you would need the previous chapter to use it. You would need the previous chapters to a new chapter because you'll evolve the new ones, right? The previous chapter will be using a new chapter. You can see how we're using the previous chapter to chapter gift on this chapter. You see how we're using the daily range on this chapter, right? We're using everything on the previous chapter to this brand new one, right? If you guys new, make sure you guys join my Discord, ETU. Join the family. Like, subscribe, comment, and yeah, thank you for watching. I'll see you in the next chapter. Make sure you guys are taking notes. Peace out.